Hello, I'm Katie St. Ors, certified financial planner, tax strategist, and producer of The Deep Dive. Welcome to Season 3, Episode 36, and today we will do a deep dive into the Federal Reserve and its chairman. Okay, it looks like Elizabeth and Michael have their coffee filled and are settled in behind the microphones. So, let's get going.
When you really want to get something important, cut through all the noise and just understand what makes it tick.
Yeah, definitely.
That's what we're doing today. We're taking a deep dive into the Federal Reserve, the Fed, and, crucially, the person leading it, the chair.
Mm-hmm.
Think of this as your shortcut, your guided tour to understanding a really critical piece of the whole economic puzzle.
Absolutely. And the material we have is, well, it's a great starting point. We've got an article giving that broad overview,
Right.
And then a blog post that helps clarify some of the maybe trickier aspects.
Good.
So our goal here is really to pull out the key insights from both, so you walk away actually understanding what the Fed and its chair do, and maybe more importantly, why it matters to you.
Okay, let's start at the beginning then.
Mm-hmm.
The Federal Reserve System, it hasn't always been here, has it? Established back in 1913. What was the big push for creating it?
That's right, 1913. Well, before that, especially in the early 20th century, the U.S. had these recurring financial panics. Nasty stuff. Bank runs, economic instability. It really shook confidence. So the Fed's creation was a direct answer to that chaos.
To bring some stability.
Exactly. The idea was to have a central authority, a body that could act as a stabilizer, prevent those widespread bank runs, cushion the economy. You could think of it like maybe an economic thermostat.
Right.
Or a shock absorber for the financial system.
An economic thermostat, I like that.
Okay.
And it has these core goals, this dual mandate we hear about. Maximum employment, stable prices.
Correct.
Plus, people often mention moderate long-term interest rates. Why those specific targets? What makes them so important?
Well, they all kind of work together for a healthy economy. Maximum employment, that's pretty straightforward, right? Getting as many people working as possible. That boosts prosperity, financial security for individuals.
Sure. Jobs.
And stable prices. That means your money holds its value.
Yeah.
The cost of living isn't jumping around wildly. Your paycheck actually buys stuff consistently.
So controlling inflation.
Right. And moderate long-term interest rates. That helps businesses invest, helps people afford big purchases like homes or cars. It encourages, sustainable growth, not booms and busts.
Okay, that makes sense. So how is this thing actually structured? It sounds a bit complicated. Board of Governors, Federal Reserve Banks, the FOMC.
It can seem complex, but each part has a distinct job. You've got the Board of Governors in Washington, D.C. Think of that as the central oversight body.
The headquarters.
Sort of, yeah. 7 members, and they're appointed by the president, confirmed by the Senate.
Okay.
And here's a key thing. They serve these long 14-year staggered terms.
14 years, wow. Why so long?
It's designed specifically to insulate them from short-term political wins. The idea is they can focus on the long-run health of the economy, not just the next election cycle.
Political independence.
Okay.
Got it. And then there are the regional banks.
12 of them.
Yeah. 12 Federal Reserve banks spread across major cities.
Incorporate right the first time. Trust Busy's 20 years of experience. Over 1 million entrepreneurs served since 2004. Launch your dream. Click the link below to get busy.
New York, Chicago, San Francisco, Dallas, and others.
Mm.
And they're not just branch offices.
No. What do? They're really the Fed's operational arms out in the field. They supervise local banks in their district, handle financial services like check clearing.
The plumbing.
Exactly. And maybe most importantly, they gather economic intelligence, like right from the source, talking to businesses, community leaders in their regions.
So they have their finger on the pulse locally.
Precisely. That on-the-ground information is incredibly valuable for the policymakers back in D.C., and each regional bank has its own local board of directors, too, bringing in diverse viewpoints.
Interesting. Okay, and then the big one, the FOMC, the Federal Open Market Committee, that's where the interest rate decisions happen, right?
That's the main stage for monetary policy, yes. The FOMC, it's made up of the 7 governors from the board,
Okay.
the president of the New York Fed, they have a permanent seat, which is significant, and then 4 other Reserve Bank presidents who serve 1-year terms on a rotating basis.
Rotating, so the perspective changes.
Exactly. It brings in different regional viewpoints directly into the policy debate. They usually meet 8 times a year, look at all the economic data, and decide the direction for monetary policy. And yeah, those rotating presidents can definitely lead to some lively discussion.
I bet. Okay, so the FOMC sets the course. What tools do they actually use? How does the Fed, do monetary policy?
Right, the tools. Well, conducting monetary policy is probably their most visible function. It's all about influencing money and credit, how much is available, how much it costs to hit that dual mandate we talked about.
Right.
And the primary tool, the one you always hear about, is adjusting the target range for the federal funds rate.
The federal funds rate. Okay, remind me, that's the rate banks charge each other for overnight loans.
Exactly that. It's the interest rate for banks borrowing reserves from each other overnight. By setting a target for this rate, the FOMC influences borrowing costs basically across the entire economy.
How does that work?
Well, if the Fed lowers the target range, it generally gets cheaper for banks to borrow reserves. That tends to push down other interest rates for mortgages, car loans, business loans. It can encourage borrowing and spending, hopefully boosting the economy.
And raising the rate does the opposite.
Correct. Raising the target range makes borrowing more expensive, which can help cool down an overheating economy and fight inflation.
Okay. And it's not just the federal funds rate target, is it? I hear about open market operations. That sounds abstract.
It does sound a bit technical, but it's really fundamental. Open market operations are the Fed's main tool for actually hitting that federal funds rate target day to day.
How?
It involved the New York Fed. Remember, they have that permanent FOMC seat, buying and selling U.S. government securities, like Treasury bonds, on the open market. So when the Fed buys securities, it pays for them by crediting the reserve accounts of the seller's bank. That injects money or reserves into the banking system. More reserves usually means banks are more willing to lend to each other at lower rates, pushing the federal funds rate down towards the target.
And selling securities pulls money out.
Exactly. Selling securities takes money out of the banking system when buyers pay, reducing reserves and nudging the federal funds rate up. It's a constant adjustment process.
Interesting. And then there are reserve requirements and interest on reserve balances. Those seem less prominent.
They are less frequently adjusted tools these days, but they're still part of the toolkit. Reserve requirements are the rules about how much money banks have to hold in reserve, basically what percentage of their deposits they can't lend out.
Okay.
Historically, changing this was a major tool. Lowering the requirement freed up more money for banks to lend, raising it restricted lending.
But it's a bit of a blunt instrument.
Right, and interest on reserves. Yeah, this one's become more important. The Fed actually pays interest to banks on the reserves they hold at the Fed. By raising this interest rate, the Fed gives banks more incentive to just keep their money parked at the Fed instead of lending it out.
Ah, so it can influence lending decisions that way.
Precisely. It helps keep the federal funds rate within its target range because banks generally won't lend reserves to each other for less than they can earn, risk-free from the Fed. Lowering the interest paid on reserves encourages more lending.
Okay, so that's monetary policy. But the Fed does more, right?
Yeah.
You mentioned stability earlier. Regulation.
Absolutely. Supervising and regulating banks is a huge part of their job. They oversee a wide range of financial institutions, bank holding companies, state banks that choose to be members of the Federal Reserve System.
And make sure they're safe.
Exactly. Safe and sound, making sure they aren't taking on excessive risks that could, blow up and hurt the whole financial system. This includes setting rules about how much capital banks need to hold as a buffer against losses.
Preventing another 2008, basically.
That's a big part of the motivation, yes. And it ties into their role in maintaining overall financial stability.
How so?
Well, beyond regulation, the Fed monitors the financial system for emerging risks. And critically, it acts as the lender of last resort.
Ah, the discount window. I've heard that term.
Right. If a generally sound bank finds itself short of cash temporarily, maybe due to market stress, it can borrow directly from the Fed through the discount window.
Like an emergency loan.
Essentially, yes.
Yeah.
It prevents a temporary liquidity squeeze at one bank from turning into a solvency crisis or spreading panic through the system. It's a vital backstop.
Keeps the financial plumbing from getting totally plugged.
Good analogy. And speaking of plumbing, the Fed is actually involved in the payment system plumbing itself.
Oh, yeah.
They play a pretty critical, though often invisible, role. They help clear checks between banks, and they operate major electronic payment systems like FedWire, which handles huge sums, trillions of dollars every day. And now FedNow for instant payments. Plus, they act as the main bank for the U.S. government itself, handling treasury auctions, managing the government's accounts.
Busy institution.
Very. And one more area, they also have a role in consumer protection and community development.
Really? How does that fit in?
Well, they administer some key consumer finance laws, ensuring fairness and lending, things like that. And they encourage banks, through the Community Reinvestment Act, for example, to meet the credit needs of all parts of their communities, including low and moderate income areas. It's not just about the big banks and Wall Street.
That's good to know. Okay, so we have this complex, powerful institution. Let's talk about the person at the very top, the chair. How does someone get that job? It seems incredibly influential.
It really is one of the most powerful economic jobs in the world. The chair starts as one of the 7 governors on the board.
Okay, so they're already a governor.
Yes. Then the president nominates one of those governors to be the chair. That nomination then needs to be confirmed by the Senate, just like the initial governor appointment.
And how long do they serve as chair?
The term for the chair is 4 years, and it's renewable. So a president could reappoint a chair for another 4-year term, provided the Senate confirms them again. Their term as governor, remember, is 14 years, so their time as chair happens within that longer term.
Right. 4-year terms for chair, potentially multiple terms. What does the chair actually do, besides wielding a gavel at meetings?
Well, they do wield the gavel, metaphorically at least. They lead the Board of Governors, setting the agenda, guiding discussions, and crucially, they chair the FOMC meetings.
So they're central to monetary policy decisions.
Absolutely central. They play a huge role in shaping the discussion, framing the policy options, and trying to build consensus among all those governors and rotating bank presidents. Remember, those members have their own analyses, their own regional perspective.
So the chair needs to be a consensus builder.
Very much so. Forging agreements among those often strong-willed economists is a key part of the job.
And then they have to explain it all to the rest of us. The chair is the main spokesperson, right? Markets hang on their every word.
That's totally right. They are the primary public face and voice of the Fed. Their press conferences after FOMC meetings, their speeches, their reports to Congress, it's all incredibly important.
Why so critical?
Because they need to clearly explain what the Fed decided, why they decided it, and what their outlook is. Markets react instantly to this communication. Even a slight change in tone or phrasing can send ripples through global financial markets. So they have to be incredibly careful and precise in their language.
High-stakes communication.
Extremely. It's about managing expectations and providing clarity, reducing uncertainty as much as possible.
Yeah, I think you mentioned Congress earlier. They have to testify.
Yes, that's a formal requirement. The chair has to appear before relevant committees in both the House and the Senate twice a year. It's often called the Humphrey Hawkins testimony.
You love that.
They present the Fed's monetary policy report, discuss the economic outlook, explain recent policy decisions, and answer questions from lawmakers. It's a key accountability mechanism. And they often testify on other specific issues, too, beyond those 2 required appearances.
Facing the music, so to speak.
Incorporate right the first time. Trust Busy's 20 years of experience. Over 1 million entrepreneurs served since 2004. Launch your dream. Click the link below to get busy.
Do they interact much with the White House or Treasury?
Oh, yes. There's regular communication with the executive branch. The chair typically meets regularly with the Secretary of the Treasury to coordinate on economic matters.
Makes sense.
And they engage with other government officials, too. The chair often acts as an important economic advisor, especially during crises. Think about the COVID pandemic. The Fed chair was central in advising on and implementing emergency economic support measures alongside the Treasury.
Right, that close coordination was vital.
Yeah.
What about internationally? Does the chair play a role there?
Definitely. The U.S. economy doesn't exist in a vacuum. The chair represents the Fed and often the U.S. in major international economic forums.
Like what?
Things like meetings of G7 or G20 finance ministers and central bank governors, gatherings at the Bank for International Settlements, BIS, which is like the central bank for central banks, and interactions with the IMF. They talk policy, coordinate where possible, and share insights with their counterparts from other countries.
So it's a global role, too. It sounds like the chair is much more than just an interest rate setter. There are a CEO, a diplomat, a chief communicator.
That's a great way to put it. The sources call the chair the chief executive officer of the board and the leading voice on U.S. monetary policy. Their influence really goes way beyond just the federal funds rate. It's about shaping expectations, guiding the narrative, and performing that constant balancing act.
Balancing act between what?
Between controlling inflation, fostering maximum employment, and ensuring the whole financial system stays stable and resilient. It's navigating a constantly shifting economic landscape.
Okay. We've gone through what the Fed is, what it does, who the chair is. Let's bring it back home. Why should our listeners, really care about all this? How does it actually affect their daily lives?
Right, this is the crucial connection. And it affects people in very direct ways. Think about borrowing money,
Okay.
planning to buy a house, get a car loan, use a credit card. The interest rates you pay on those are heavily influenced by the Fed's policy decisions, especially that federal funds rate target.
So when the Fed raises rates, my mortgage could get more expensive.
Generally, yes. Or a new mortgage certainly would. The rate you're offered reflects the Fed's actions. Same for car loans, credit card interest rates. It directly impacts the cost of borrowing for big life purchases or even just managing monthly finances.
Okay, that's pretty direct. What about the flip side, saving money?
It affects that too. The interest you earn on your savings accounts, on CDs, certificates of deposit, that's also influenced by the Fed's interest rate policies.
So higher Fed rates might mean better returns on my savings.
Typically, yes. When the Fed is raising rates, banks often pass some of that along in the form of higher yields on savings products, so it impacts how fast your savings can grow.
Got it. Borrowing costs, savings returns. What else? You mentioned employment earlier.
Yes, that dual mandate goal. Maximum employment. The Fed's policies aim to create conditions where the economy is strong enough that businesses are hiring and people who want jobs can find them.
So it affects job availability.
Absolutely. A healthy job market, stable employment, that's a direct goal of the Fed. Their actions can influence business confidence, investment, and ultimately the number of jobs available and the security people feel in their jobs. It affects your career prospects, your income stability.
That's fundamental. And the other part of the mandate stable prices, inflation. We definitely feel that at the grocery store.
Right. Everyone feels inflation. When the Fed works to keep inflation low and stable, around their target, usually 2%, it protects the purchasing power of your paycheck.
Meaning my money goes further.
Exactly. It means the cost of everyday things, groceries, gas, rent, isn't constantly eroding the value of the money you earn. So the Fed's fight against inflation is directly about maintaining your standard of living.
Okay, let me try to quickly recap then. The Fed is the U.S. central bank.
Yeah.
Its main job is guiding the economy towards stable prices and maximum employment, that dual mandate.
Yep.
They use tools, especially adjusting interest rates like the federal funds rate, and also things like open market operations and bank supervision.
Correct.
Leading all this is the Fed chair, appointed by the president, confirmed by the Senate, who leads the board, chairs the FOMC, communicates policy, and represents the U.S. internationally.
You got it.
And the reason we should care is because their decisions directly hit our wallets through interest rates on loans and savings, through job opportunities, and through the prices we pay every day.
Exactly. It might seem distant, this big institution making decisions, but those decisions ripple out and have very real, tangible effects on everyone's financial life.
Okay, so to leave our listeners with something to chew on, here's a final thought. We've talked about this immense influence the Fed chair has. Considering that power, what factors, what criteria do you think are most important when we're evaluating how effective the Fed chair is? Is it just about hitting those inflation and unemployment numbers? Or should we also be looking closely at, say, financial stability, or maybe the long-term health and resilience of the economy, things that are harder to measure month to month? It's definitely something worth thinking about, especially next time you see the Fed chair in the headlines.
Thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
And that's a wrap on this deep dive. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. Link is in the description. Thanks again for tuning in, and I'll catch you on the next deep dive.